Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, November 28th, 2023. As always, we'll start with the executive summary from our leadoff morning note. If you want the analysis supporting these conclusions, as well as what to do about them in your portfolio, as always, you need to be a client of 42 Macro. So, starting with number one, this past week has seen a flurry of sell-side estimates for year-end 2024 S&P 500 targets, with the price of right around 5,000 becoming an entrenched node in what is shaping up to be a bimodal distribution that features roughly 4,500 as the other. 5,000 on the S&P 500 would represent both a new all-time high and roughly a roughly 10% gain from the current closing price. Number two, recent leadoff morning notes have featured discussions surrounding what would have to take place fundamentally to achieve that outcome. For example, rising expectations of a soft landing vis-a-vis sustained elevated productivity growth, a continuation of the nascent uptrend in global liquidity, a continuation of the low net coupon financing regime by the U.S. Treasury Department, tepid policy normalization by the BOJ, and Beijing accelerating fiscal and monetary support for the Chinese economy, among other things. Today's note focuses on whether that optimistic node of that bimodal distribution is priced in. Number three, the short answer is no. Our analysis of relative valuation suggests there is ample scope for Magnificent Seven names to continue appreciating on a relative and absolute basis, especially if the U.S. equity market adopts Nifty 50 characteristics amid what could be an incredibly boring year from an economic perspective. Communication services and industrials stand out as having demonstrable upside among S&P 500 sectors. Transitioning to my 42 macro dashboard this morning, we're getting a near overbought signal in gold here, so just be aware that the top side of the range continues to move higher, though, so it's not exactly a hard sell there. You're getting an oversold signal here in the Treasury, the 2-year Treasury yield. That would obviously, if that bounce would take some wind out of the sails of gold vis-a-vis strengthening the dollar, but a very narrow range, so it's not like you need to be heading for the heels here as well. What else do we have here in terms of overbought, oversold signals? We got a near oversold signal in agriculture, but again, that range continues to widen to the downside. So again, may continue to see a little bit more downside before we start to see a bounce there. Transitioning to our 42 macro aware community, we got a question this morning, a couple questions actually over the last couple of days, talking about some of our bottom-up macro regime forecasting processes, and really the general gist of the question is what to do about forecast and in terms of how to incorporate that into the investment process. And the simple answer is we at 42 Macro, Darius Dale, the founder and CEO of 42 Macro, we don't use forecasts at all in our investment recommendations, portfolio construction advice, and our asset allocation recommendations. All of those are born solely out of our quantitative risk management signals and the interplay between those particular components of our process. From my perspective, I think we do as good, if not a better job of forecasting the economy as anyone. I quite remember quite cogently that yours truly, the person sitting in this chair with the light blue sweater on, is the human being on earth that authored the resilient U.S. economy theme back to summer of 2022. That's obviously cost a lot of people a lot of money, both in terms of getting squeezed by stocks and blown up in the fixed income markets throughout 2023. Whether you could have positioned for that in full size and then absolutely got blown up in the regional banking crisis in February to March, in so much that you could have gotten blown up on the short side of bonds, et cetera, in the last couple of weeks. So in our opinion, I think forecasting, while a very valid and useful exercise in terms of trying to think about how much risk to take, I don't think it necessarily needs to guide what risks you take. I liken, investing with forecasts akin to driving while just staring at the GPS in the center console of your car. To me, that's what investing based on forecasts for. There's this giant thing called the damn windshield that you probably should be looking out of when you're driving and operating a motor vehicle. But so many investors, particularly retail investors, folks who don't have the experience and acumen that that our institutional clients have, tend to focus on that GPS, because they get wedded to colorful narratives and they get wedded to these stories. And ultimately, those stories cost them a lot of money in terms of risk managing financial markets poorly. So kind of just wrapping up this discussion, no, we don't incorporate forecasts into our portfolio construction guidance, our asset allocation guidance, our tactical trading recommendations. Those are all based on proven quantitative techniques and secondarily, we believe forecasts are very valuable. They can help you think about the kinds of risks, the amount of risks you should be taking, but specifically the kinds of risks and when you take them on, or you take them and when you take them off specifically. In our opinion, I don't think forecasts should have anything to do with that, especially given the amount of forecast error we've seen accumulate throughout the post-pandemic period, not just obviously at the Federal Reserve in terms of missing the inflation bout, but the entire Wall Street and both buy side and sell side in terms of missing the resiliency of the economy. I think people will be very, very. I think they should probably learn some lessons from those huge, massive gaps as we head into 2024. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, November 28th, 2023. Best of luck out there today. We'll catch you back here tomorrow. Cheers.